Hey, this is Arthur Hill, Senior Technical Analyst with StockCharts.com. It is Tuesday, April 23rd, and you're tuned into On Trend, the show designed to keep you on the right side of the trend. So we'll start with a little broad market assessment and show you why the bull market is still intact. Basically, the big five sectors are still leading, or five of the big six. We'll look at small caps as they hit their moment of truth and test the breakout. We've got the Fang Stocks, clearly not dead. We'll look at some ETF breakouts. The bond ETFs are reaching their moment of truth, and we got some stock setups to watch. So we're going to start off with a chart list that has the 11 sector SPDRs plus SPY. And the reason I'm doing this is I just want to look at the state of the market, especially in 2019, because we've been in a strong uptrend all year. And I want to see which sectors are leading and how broad that leadership is. And you can do that by looking at these 11 sector SPDRs. And I threw in SPY as well. That kind of acts as the benchmark. So here you can see the names I've got on the chart list, and I preface the names with a number so I could get the sequence that I want as far as the sector order is concerned. So I've got the defensive ones at the bottom, basic materials and energy in the lower half, and then at the top I've got the big six, as I call them, because these six sectors account for over 72% of the S&P 500. Now, I sometimes go to the fund family websites. This is the SPDR's website. Today, I'm on the ETFdatabase.com website here to look at the details for SPY. And they've got a lot of details for any kind of ETF that you're interested in. And if you scroll down there, you can see the holdings as far as the top stocks are concerned. Microsoft is the biggest holding. Google is listed twice there, but those two added up do not surpass the weighting of Microsoft at 3.9%. And then a little bit further down, we can see how the sector breakdown works. And there you can see technology is the biggest sector. I'll go back up so you can see technology, financials, healthcare, communications, cyclicals, consumer cyclicals, industrials, and then consumer non-cyclicals, which would be consumer staples. So we can see that these top six sectors here account for over 70% of the ETF, and they are the main drivers. So I'm currently viewing this chart list in edit format. There you can see at the top, view list as. And from that drop down, I can select summary format or a number of others. And I'm going to go to summary first because I want to show you how performance has been. And in the upper left-hand corner, you've got intraday. And if I go year to date, and then I click that change to make sure I'm sorted with the top performers at the top, there you can see the top performing sectors in 2019. We've got technology, by far the leader, followed by industrials and energy and consumer discretionary. All four of these are up over 20%. Communication services is up 20% for all intents and purposes. So these are outperforming SPY. There it is as a benchmark. And then you got the financial SPDR up 15%. So we got big gains coming from five of the six big sectors this year. And there you can see healthcare is the weakest sector. It is just negative year to date because it is down 0.25%. So it is the weakest sector. But what's interesting, if you go to the 1 month time frame here, we can see that financials have started to outperform. They had a really good month, and industrials are also having a good month, and consumer discretionary and technology continue to perform well. Now, I'm not using this because I want to buy or sell one of these sectors. Frankly, I found these sector SPDRs to be pretty frustrating as far as trading vehicles are concerned. They're just too whippy because there's too many stocks and it's probably a stock picker's market. But I use this to find out if enough or if the key sectors that I want to see participating in advance are participating to support the broad advance that's currently underway in the stock market. And the short answer is yes. 5 of the 6 big sectors are clearly supporting this advance. The only one that is not is down here is healthcare. It is not supporting the advance, but hey, you can't have everything. 5 of 6 is plenty enough to propel the S&P 500 higher. So now I'm going to move to a different format. I'm going to go to Candle Glance. Well, actually, no, I'll go to 10 per page so we can get a little detail on these charts. So there you can see SPY, and this is a dividend adjusted plot of SPY. And so if you include dividends, SPY is right near that September-October high. I'm not calling that resistance. Why? Well, because the 20-day is above the 200-day. You can see that price is above the 200-day, and we're in an uptrend. And in uptrends, I do not look at resistance levels because you expect higher highs. So that's why I'm not marking that as resistance. Now, if we look at some of the big important sectors, there you can see consumer discretionary on a dividend adjusted basis. It is hitting a new high, and the 20-day is above the 200-day. And there you can see RSI moving above 70 a few times. So clearly there's an uptrend and there is strong momentum in SPY, and that supports the bull market. Technology has been pretty much straight up since that bottom, that V kind of bottom in January or late December, and it is hitting new highs as well. RSI several moves above 70. Communication services, which started trading in June, is below its summer highs, but you can see that it's got a breakout there in January, February, March there, and is new highs for 2019. So it is performing just fine. We look at financials. This is one of the weaker ones. It's still below its September high, but it is getting a break above the February, March highs and did hit a new high for the year. But, it's not my preferred sector because it's really underperforming because there are other stronger sectors like industrials, consumer discretionary, and technology. Speaking of, here is the industrial sector. It is very close to its September high, and you can see a little consolidation there, a little pullback there, and we got a breakout out of that pattern, a little throwback after the breakout, and a move higher. So looking strong in industrials. Then we look at healthcare. The only positive here is you can see RSI is oversold for the third time since October. And when it moves back above 30, you tend to get an oversold bounce. And, this late December bounce, of course, was great. This bounce here in October was pretty good as well. Then you had a sharp pullback. So now we're kind of firming here. And if RSI moves back above 30, that could give way to an oversold bounce for healthcare. But again, it's not the preferred sector because you can see I just pointed out the three that are even stronger. Now we look at some of the smaller sectors. Basic materials, it's about 3% of the S&P 500, so not a big weight here. But, it's not a preferred sector either. It's below these summer, fall highs there. Energy, it's perking up, but it's just not a preferred sector yet here because it's still well below these September highs and it's just now clearing the 200-day, so it's still a laggard overall. Consumer staples is not a laggard. There you can see consumer staples is making new highs here in April. It was above the 200-day there in early February, and the 20-day crossed above the 200-day about a week later. So this is one of the strongest sectors right now. And then if we move to the next page, we can see utilities are correcting after a big move, but this looks more like kind of like a flag wedge. So you got a big surge. And if we get a breakout there, that's going to be bullish. And REITs had a pretty hard pullback. They were leading up until early April and then got that pullback last week. So we'll see what happens there. But, it's still in an uptrend. So we've got SPY hitting a new high. We've got QQQ hitting a new high. We've got leadership from 5 of the 6 big sectors, plus consumer staples is also in that leadership group. Probably throw in utilities and REITs, even though they pulled back. But clearly the bulk of the market, the majority of sectors are strong. Now, there are weaker pockets in the market, and one of those weaker pockets would be small caps. Now, keep in mind, small caps account for less than 10% of the total U.S. market cap. So they're 1/10 of the market at most, probably more like 8% to be more realistic. So they're not a big driver of the market. The S&P 500 is still the 800-pound gorilla in the room, and that's the one we watch for clues on the broader market. Now, small caps are lagging because you can see here IWM has yet to clear this high here from latter part of February. But on the positive side, we did get a breakout there in early April. So we had this corrective formation. So you had basically like a 27% advance there from late December to the latter part of February. So you're entitled to a pullback after that. And we had a falling flag, channel, wedge, whatever you want to call it. It really doesn't matter. It's kind of a slow correction pullback after a sharp advance. And now we're breaking out. And we're at a moment of truth because you can see that this breakout zone, we had a little pullback in the second week of April. We've got another one happening right now. And this is kind of the moment of truth for the breakout. And I think as long as 154 holds, then this breakout is valid and bullish. But if you move below 154, then you have to reevaluate the validity of this breakout. Now here is IJR, which is the S&P 600 small cap ETF. And you can see I've got RSI down in the indicator window with the 40 to 80 zone shaded green. And that's typically the bull zone for momentum. But you know, with small cap indexes, you tend to get overshoots and it doesn't work as cleanly as it sometimes does for the S&P 500. But you can see here, we dip below 40, but then move back above. So I still think for the most part, RSI is in its bull range and has been in its bull range since the middle of January there. And if we look at the pattern at work, it's a falling channel or flag. And then we got the breakout. We got support in the 78, 79 area, and we're testing it again. So this is a moment of truth for IJR. Now, if we move below 78, would I turn very bearish and short the S&P small cap indexes? Well, I don't think so, because as long as the broader market environment remains bullish, I would not be interested in short positions. Now, admittedly, I did attempt to short the market in the middle part or latter part of March. You can see here when IJR, just after the Fed meeting, this is IWM, was starting to break down. And I used RWM, which is the inverse ETF, as the vehicle. So you had this breakdown, but you can see you firmed with a spinning top candlestick and had that little gap up, and then followed through with the breakout here. And this just points out the pretty much danger of trying to short when the broader market environment is bullish. In fact, trying to short, period, is a very difficult proposition for making money. Now, much has been made about the demise of the Fang stocks, but I am here to report that the Fang stocks are doing just fine. And I've got a chart list here. I've got the Fang stocks plus a few others that I threw in there that you'll see coming up there. There's 11 stocks, and I've got SPY in there just so we can always see what SPY is doing as well. And I'm using the candle glance charts here. I've got a custom candle glance style that I've created. I like a very simple chart. All I pretty much need is the price. I'm looking at the close only here. Got the 200-day moving average, and I've got 14-day RSI. And so if we look at the first of the FAANGs here, we've got Apple, Amazon, Facebook, and Alphabet, which used to be Google, still is Google to me. But if you look at these charts here, you can see that they are all above the 200-day moving average. Amazon is taking a nice big move after that breakout there above the 200-day. So is Google. Those two are kind of leading, and you can see the 200-day for Google is moving higher, as is the 200-day for Amazon. So these two stocks are doing just fine, I think. And then if we scroll down a little bit, we can see Netflix here, and it is consolidating above its 200-day. You can see it had that move above the 200-day, and then it was flat. And this looks like a consolidation within an uptrend, so I would expect a move higher here. So that covered the 5 FAANGs. And if we look at some other stocks, look at Intel and Microsoft. These two are leading the market. Intel got the break above its 200-day and the break above that resistance level there in February and just hasn't looked back, hitting a new 52-week high. Microsoft had the correction into December and then broke out there in February as well, and is hitting new highs throughout March and April. So it's a clear leader. We look at NVIDIA. Yeah, can't be on the list as far as a momentum stock anymore because it's below its falling 200-day, but it's had a nice rebound since the latter part of December. And then I threw in PayPal Holdings, Tesla, and Twitter. And, PayPal broke out in December and it continues to move higher. And if we look at Tesla, it is one of the weakest stocks in 2019. It is actually down year to date, and there aren't very many stocks in the NASDAQ 100 that are down year to date. Most of them are biotechs. And if you look at Tesla here, you can see that it has just been trending lower. It's coming into this potential support zone here, but I would say it needs to be avoided because of this underperformance and this downtrend that's currently underway, even though support is at hand. Twitter's kind of locked in a trading range there. You can see around 36 resistance and then the 25 area for support. So it's kind of a do-nothing stock. But you can see the leaders clearly are PayPal, Microsoft, and Intel. They are the strongest of this group. And then I think Google and Amazon are looking good as well. Now we're going to look at some ETF leaders and breakouts. Some of the breakouts happened at the end of March, some of them in April here. And I also want to point out this bifurcation that we're seeing in the market. You take the consumer discretionary sector. You've got leadership coming from home construction. You can see here that it got the breakout there in the latter part of March. You had this little flag formation, and then there's the breakout, and it's hit a high of the year. You can see there intraday yesterday, and RSI moving above 70 several times. As momentum holds, the RSI indicator holds in its bull range. So clearly strength in home construction. And you would think if home construction is strong, that retail should be strong. After all, it's part of the same sector. It's a cyclical group. It's domestically oriented. But, look at the retail SPDR. It does not look like a happy camper. You can see the bigger breakdown that it had in October and then again in November. And it came back to that 61.8% retracement in early March, pulled back with a wedge. Looked like it was getting a wedge breakout in late March, but look at that decline yesterday. It just completely failed. And what we're not seeing in this advance that we've had in 2019 is any momentum. And how do we know that? Well, RSI has yet to break above 70. All these moves have been below 70. So even though XRT is up substantially from that December low there, it doesn't have the momentum needed to sustain an advance. So, retail is still to be avoided. Maybe you can pick and choose among individual retailers, but as a group, I would avoid them. So we're also seeing strength throughout the technology sector. And one group that I'm going to point out here is Hack. And I got a couple of cybersecurity stocks later on. But if you look at Hack here, you can see that, broke above the 20-day broke above the 200-day there in middle of February. And then you can see price broke above resistance there in early February. And we've been making higher lows and higher highs since then. And RSI moved above 70 a couple times there and is holding in that 50 area. So clearly Hack is one of the leaders out there. The semiconductor group is also showing strength. Here is the SOX ETF, SOXX. You can see the breakout there in late January, early February, a couple of small pullbacks and breakouts and some gaps along the way and new 52-week highs. Sure, it's getting extended with RSI hitting 75, and that's because of leadership from Intel, which has really been strong. And as far as a potential support level to watch, you kind of have resistance turning support in that 190, 195 area. So if you get a throwback to that area, that might be an opportunity to watch for. But the main point is SOX is strong, and that's positive for the market. Now, as far as more recent breakouts are concerned, we've got breakouts in the two aerospace and defense ETFs. This is ITA. And yeah, V bottoms are hard to play. You have the sharp decline and the sharp advance. So it was hard to catch the move here, but then we got the playable pullback, as I called it. And this formed a wedge of sorts there. So you got above the 200-day, you came back to the 200-day and bounced. And there you can see the little breakout there, another throwback in early April and bouncing again. So as long as this one holds the 200-day, which is starting to turn up there, I think this is a positive here. And a lot of aerospace and defense stocks are going to be reporting in the next couple of days. The other ETF is the Invesco PowerShares ETF. PPA is the name. It's a little bit stronger than the other ETF. You can see here that it's already above this high here from late February or mid-February. So it's hitting a new high for the year. But, it still has the wedge and the wedge breakout working and RSI in the bull zone there. Now, many of the solar stocks are also part of the industrials ETF. Some of them are also part of the semiconductor ETF, believe it or not. But if you can see, as you can see here, here's TAN, and it's getting the bigger breakout there with the move above that high and above the 200-day. And now the 200-day is starting to turn up. You had a little wedge type of correction and a break out of that wedge there in early April. So this one looks like it wants to continue moving higher. And you can see RSI is in its bull range there. Now, I'm not a big fan of the energy sector, but there's no denying the advance that we've seen in oil in 2019 and leadership in 2019 from the energy sector, XLE. And if you look at the oil and gas equipment services ETF, it's getting a breakout there with a pretty nice move yesterday. So we basically have a sharp advance and then a consolidation. Yeah, it's not a picture-perfect flag, but that's the essence of the pattern. You had a big advance from 8 to 12. That's like a 50% advance. And then you digested those gains with this consolidation, and now we're breaking out. So it looks like XES wants to move higher. Now, this is a low-price ETF. It's below the falling 200-day moving average, and it hasn't shown any real momentum since May. If you look at RSI, it has not been above 70 since May. So these moves here, while they seem strong, have not been enough to push RSI above 70 and show strong upside momentum. So that's why, I would rather watch this than play it personally. Now, we've got an interesting setup in the bond ETFs, IEF and TLT, and it's basically a pullback within a bigger uptrend, and at the same time, it's like a throwback to the broken resistance level. So here is the IEF, the 7 to 10 year Treasury bond ETF, and we can see the first breakout there in November. Big advance from middle of November to the end of December. And then a long consolidation and a breakout. And there's the breakout zone. And we got, overbought around 107 and pulled back to this zone here. And you can see that retracement or pullback has retraced 61.8% of the prior advance. So we got two reasons to expect a reversal in that 105, 104.5, 105 area. First, you got broken resistance turning into support. Second, you got the 61.8% retracement. And so now that we've come to this area, I start looking for signs of an upturn. And we got one with a gap up on Friday, well, it's not really a gap because it's reacting to what's already happened in the bond market, as the bond market is open before the stock market. The futures are trading. But if we get a breakout there at 105.5, then that would be bullish. And in the indicator window, you can see that the commodity channel index moved below minus 100 there in March and turned up, and it's doing the same now, trying to turn up. This is similar to RSI. You can use either one. I mix them both up, but they pretty much do the same thing. They're an oscillator that becomes oversold and overbought with easily identified levels. And I only look at oversold levels when the bigger trend is up. I ignore overbought levels like you saw here in November and December and January and February, because overbought is expected in an uptrend. It's when you get oversold that you have a potential opportunity in an uptrend, because that means you've had a pullback. Now, if we look at TLT, we see a similar setup there. And so that's why I've got bonds on my radar quite closely this week. You've got the breakout, the return to the breakout, the 61.8% retracement. CCI is below minus 100 and trying to turn up. So if we get a little breakout there above that high from last week, that is going to be bullish for TLT. So the first two stocks come from the cybersecurity group. This is SecureWorks, which is a spinoff from Dell Technologies. Yes, that Dell from Dell Computer. And we can see a new high there in January, and then a pullback that looks corrective in nature because it's above the rising 200-day moving average. Kind of a falling wedge is forming, and you can see a little high there at 20 last week. And so if we get a breakout there, I think that's going to signal an end to the correction and a resumption higher. The next stock is Symantec, and we can see here that we've got a double bottom there with two lows, and then in between we have an intermittent high marking resistance. And we got a break above that resistance zone with the gap up, and that breakout is holding. And you can see MACD's above its signal line, and the 200-day has been turning up. So it looks pretty positive here for Symantec. Keeping with technology, we've got Ciena Corp, which is part of the networking group. And you can see first the trend is up above the rising 200-day moving average. That was a 52-week high there in late February, early March. And then we have this kind of pullback here, and you can see a resistance zone kind of turning into support in that 36, 37 area. And we're starting to firm. And I noticed we had a little gap up last week. So it looks like Ciena is trying to make a bounce off that support level. Now, cannabis stocks started making moves over the past few days. This is Aurora Cannabis. And keep in mind, these are high-risk plays. But you can see Aurora is above the rising 200-day moving average. It had a nice big move from December to March and then corrected with what looks like a triangle of sorts. And it looks like we're getting a breakout out of this triangle now. We look at Canopy Growth. It had a big move and looks like it's breaking out of a corrective pattern. You had the big surge and then this correction here that you can see, and we're breaking out of that correction with a sharp move higher. A lot of risk here, but potential reward as well. And finally, Kronos. You can see here you have a resistance zone in that 15-14 area that turns into support. And we pull back to support, firm for 4 days, and it looks like Kronos is poised to bounce off support. And that concludes this edition of On Trend. Thanks very much for tuning in, and remember to stay on the right side of the trend.